It is October, and we've just come out of the worst quarter in a couple of years for the JSE. A lot is happening in the world. Trump has basically said, yes, I'd absolutely ask Ukraine and China to investigate the Bidens in public. So what are you going to say to me now?
Probably nothing.
Yeah. So we're just in a very interesting place. I think, there's fears of recession. There's everything that's going on with the oil price in Saudi Arabia and just threats from the Crown Prince about if things go wrong here, this is the next global meltdown, which, I mean, none of us want to hear those words. But maybe let's just talk about Q3 and then we'll touch on a few things that are happening on the local market and internationally.
Yeah, so third quarter, I think worst quarter since 2011, 2012, certainly in a long time. And that's a global number. I was looking, so for the close on 2nd of October, Wednesday, the S&P is basically flat since January of 2018. So almost 2 years. So we obviously look local and we're not flat over that period. We're down about 8% over that period.
Yes.
And it's been, and third quarter was rough. And we saw at the beginning of September ISM data out of the US that was very poor. We saw European, we saw some Asian ISM data coming out very, very weak. Ditto, and South Africa, of course. And then ditto again for the September PMIs and ISMs that have been coming out. Now, the ISM in US perhaps a bit skewed. There's the General Motors strike, 48,000 people on strike, and about 200,000 in the supply chain who have therefore been essentially furloughed because there's nothing. General Motors isn't placing orders. But what we are absolutely seeing is weakness in global economies. And truthfully, we've been seeing it a bit. It's just now getting a little more pointy. IMF and World Bank have been downgrading global GDP for pretty much all of last year and this, and now the data is starting to confirm it. And it's looking very much like we're going to be. I think the odds of recessions in major global economies, US, Germany, and the like, in 2020 is more than 50%. And the market is starting to price that in. And there's two drivers. One is the longest expansion on record since March of 2009, when the financial crisis ended.
In
inverted
commas.
And trade wars. And we've been saying this since day one. Capitalism likes the free flow of things, and tariffs is anti that, and it hurts. And there's some spin-offs. Japan and South Korea have got sort of low-level trade wars of their own, which has been hurting Korean growth. And it's starting to spread. Trade wars are seemingly not going away in a hurry. Threats now of imposing some on Europe as well, the EU. And this is really, really starting to hurt the global economy. And it's looking rough. And 2020 is looking like a not fun year. I mean, if you can take a year off and come back in 2021,
it would be great.
It might be recommended.
And just to look at what actually the return of the major indices in Q3, we've got financials right at the bottom, down 6.88%. What happened there?
So it's the banks. So there's one caveat to the financials, and that is Capitec.
Yes.
And in fact, in September, Capitec was up some 17%.
Yes.
Best
so
performer
top performer in the banks.
In the top 40. Top 40. But the other banks remain under pressure, and I'm sounding like a broken record because the balance sheets remain strong, the bad debts and payments remain low, and the valuations remain attractive. That said, if we are going into a tough 2020, are they going to be able to do anything more than what they've been doing, which is the low single-digit HEPS growth, Capitec aside? And the answer is probably not. In other words, they're cheap, but there's no major rush. There's no, let's go and buy them in a hurry scenario, because where's that growth, where's that repricing going to come from? And the answer is, I don't see it. So, and truthfully, swaths of our market is looking at nice value, but you need that trigger, otherwise it's value trap.
And just above SA financials were SA resources, down 6.4%, and resources have had a very good run. And one would typically imagine that the rand would have sort of played to the strengths of the resources, but we still see some of that pressure. And
and what we saw in September, so Sasol, and we can park that aside, that was obviously the biggie, but even the single commodities and the diversifieds, the rand had strengthened sub 15, and it's now 15.20 odd, it's gone the other way, but the rand had strengthened, and the commodity prices towards the end of September had come off, coupled with commodity stocks that had done incredibly well, and there was, I just think, a bout of profit taking. We saw gold under pressure, less so in the platinums, palladium doing okay, rhodium doing brilliant, platinum holding on, touched $1,000 in September, sticking around the 930, 940, still low, but way up on the 830, 840 it was trading earlier in the year. And I think there was just some profit taking, some pullbacks on it, and certainly that seems to, in the first few days of October, be starting to reverse in some of the gold miners. Implats through 100 Rand, or at least touched 100 Rand briefly, stock that was 30 odd Rand a year or less ago. And I think it was just a case of some pullback, and now we're starting to see some action come back in there, and certainly helped by a currency at 15.20. Currency driven by dollar strength of epic proportion. In my iris, I've got a screen which basically just looks at EM currencies, and across the board, the emerging market currencies were moving 1%, 2% weaker, sort of late September into sort of 1st, 2nd of October, as we saw massive dollar strength. That massive dollar strength is concerns around global economies, trade wars, and people moving their money into US dollar. You want a safe haven. So what's your safe haven? Some would tell you it's Bitcoin. They're wrong.
Gold.
Some would tell you it's gold. I think they're wrong too.
But it's the way things have always been done.
Some will tell you it's US dollar, and I know the stories about fiat currency and all of that, and etc. And maybe one day in the history of humanity, it won't be the US dollar. But right now, that is your ultimate safety place. And once you're in US dollar, you can go buy US Treasury bills at 2%. A year, and if you're worried about what's happening in the future, 2% is not bad. It's a guaranteed money. The US isn't going to default. So a lot of money flowing in, which creates a significantly strong US dollar, which of course Trump hates. And we saw Jerome Powell and the Fed cut again during September, and pretty much every central bank in the world, apart from ours, and I'm not dissing our central bank, they're a great, is cutting. And truthfully, we're in an easing cycle. Our previous MPC was a cut. I think our next MPC will probably be a cut. An easing cycle doesn't necessarily mean cut every time.
Every time, yeah. Take a measured approach to it.
Yeah, they're ahead of the curve. There's no need to panic. You want to be ahead of the curve. What that means is that if the data starts becoming a little ambiguous, you can step back and pause because you're ahead of that curve.
Yeah.
And that is rule one of a central bank: be ahead of the curve. Because if you get behind the curve, you've got to do what Turkey does and 12% changes to interest rates, which is ruinous from either side.
All right. And then just to focus on some of the big things that happened in September. So Naspers and Prosus finally listing. And obviously, I think as much as for some people this is a very beneficial thing, a lot of people don't actually know what happens if I'm a Naspers shareholder. What does this mean for my holding? So can you just take us through that? What does the listing of Prosus mean for the shareholder? And perhaps when we're done, we can talk about what this actually means for anyone who's invested at the top 40.
Yeah, so 11th September was the effective date. If you did nothing, you now have Prosus shares. And Twitter was full of people saying my Naspers has collapsed. And I'd say, but you got Prosus shares. And they were like, do I? And then they'll come back a minute later and say, phoned my broker. I do. What's happened? So what happened was you had Naspers shares. Naspers took all of their non-SA assets. So the SA assets is basically Media24 and then some startup incubators and the like,
and blah,
etc. And then so everything else, Mail.ru and not Flipkart anymore, but all their other assets then went into Prosus. Prosus lists in the Euronext in Amsterdam, and Naspers holds 73% of Prosus. And then as a Naspers shareholder, you're like, well, hang on, you just gave away the crown jewels to Prosus. Well, you then got given a Prosus share as well. So if you had 100 Naspers shares, they were 3,522 on the 10th of September, and now you've got a Naspers and a Prosus share, and your exposure to Tencent and all those different assets is exactly the same.
Yeah.
You could have elected to receive Naspers shares. That was the non-default. You had to elect for that. But the vast majority of people went with the default and got the Prosus shares. The theory is that Euronext is a European exchange. It will be the biggest tech stock in Europe. Prosus will be, and that will therefore create a lot of attraction and therefore uplift the share price. The net effect is it hasn't worked. But truthfully, we're 3 weeks into the experiment. So, it's a little early to say it hasn't worked. Tencent itself has been under pressure. There's concerns around China's growth slowing. Let's preface that, slowing to around 6% per year.
So still...
For the second biggest economy in the world, not bad.
Very impressive.
Actually very impressive, yes. So the idea behind the unlock is to try and, there was at points a 40% discount between Naspers and its holding in Tencent, and everything else was free. My theory as to why is that with a plus 20% weighting of Naspers, if you're an asset manager, you look at a stock, you look at Billiton, and your question is, do I go under, over, or at weight? So it's a 4% weighting, whatever it is. Do you go 6%, 4%, 2%, 0%? With Naspers, you can't go at weight, you can't go overweight. The question is, how underweight will I be? And even if you go 10%, that's very underweight Naspers, and that's a big position.
Yeah.
Our market just wasn't big enough for a stock of that size, of that weight in our index. The idea being that we can solve that problem via a Prosus in Amsterdam. I subscribe to the theory. It hasn't worked so far, but we're early days in, and there's lots of other worries out there around China and et cetera, et cetera. I think in time it will work. So as a Naspers shareholder at the beginning of September, at the end of September, you now have one Naspers, one Prosus, pro rata, no problem at all. What this does to the indices, so on the 11th of September, Prosus went into all of the indices that Naspers had existed in, and that was a Wednesday, and on the Monday it all got rejigged, and did Prosus qualify to stay in? The answer was yes, and it stayed in most of the indices that Naspers was in. In the top 40, Naspers had been around 22%. So if you put 100 Rand into an ETF tracking top 40,
about 22 Rand would be
into Naspers, and that's concentration risk. Now, truthfully, this is not a South African exclusive problem. We've had it before. In the olden days, it was Anglo and Billiton. And if you look around the world, typically what you find is that around about sort of a quarter of your shares within the index really are the shares that make the moves in the index because of their weighting. So in South Africa, that's the top 10, and it is correct. And the S&P, it's the top 100, and the logic works. And it is. It's in Italy, that exists across the world. Italy's actually weird. It's actually more concentrated, as is India, but they're the two outliers. What's happened now is Naspers has fallen down to around 15%.
Yes.
So that weighting has come down. Prosus comes in at around 3%. So you're sitting at around 18. So you were 22, you're now at 18%. In terms of, so you're actually technically holding a little less Naspers. Now, the ETF issuers, Satrix, Ashburton, Core, etc., they all manage this in the background. We don't do anything. That's the beauty of ETFs. There are some interesting points, however, with the capped indices. So, for example, Core Shares has a top 50 capped, where it was capped at 10%. So Naspers was only ever 10%. Now Naspers is still 10%, and Prosus is 2 or 3. So you actually got a little more exposure. Ditto with your Swix capped index. Ditto with your Indy capped index, where they had capped the number, so that meant you weren't getting fully the full Naspers
exposure.
And you're still not, but now you're actually getting a little bit of Prosus. So actually, in some indices, you've got more exposure to Tencent. In the more vanilla uncapped indices, you've got less exposure to Tencent. From Naspers's perspective, the indices are not of their concern, and this is not why they did it. They did this purely as a unlock value for shareholders. Their first value unlock was multi-choice. That did work.
Yes.
They spun multi-choice out when the stock was about 3,200, it went to 3,500, and you had 125 in multi-choice.
In multi-choice, yeah.
And as I said up front, I think the process will work. It's just it was a rough month to try that experiment.
They didn't know.
Yeah.
Okay, and then now on to Blue Label, which has been seeing, 4-year loss, double its market cap. I would cry.
I would cry.
If that was
I would hide under
my
bed.
net worth and I just lost that much money. And they've got and that's only from a 45% holding in Cell C. So it's not even the full blow.
Yeah.
What is going on there? And what is, there's so many things where, analysts are going on about Cell C needs to change their business model. And I suppose the question is to what?
So I think the bigger problem is our market big enough for telcos? America has 4 telcos. They're a 330 million size market. We're a 60 million. I don't think our market is big enough. Now, there's some nuances, as we saw, more so in the rest of the continent, but in South Africa to a degree. A lot of people never had fixed line. They went straight to mobile. Nigeria, Kenya,
Yes.
Central East Africa, and even in South Africa, to a fair degree, a lot of people kind of skipped out that copper line into your house and just went straight to mobile, not only as a telephone, but as a internet access device at the same time.
So I think, and it's worth mentioning here, so I grew up, we didn't really have it. I think we first got a telephone when I was like 9, which was obviously very interesting. But, before long, we didn't need it.
Yeah.
Actually, no, I was a bit younger. But we didn't need it for very long because then there were cell phones and so...
Yeah, there was a big rollout. And I remember the adverts from Telkom in the early 2000s. Some really, really great adverts. And
we had the telephone booths.
And there was a commitment from Telkom to government that they would roll out telephones to rural communities. But it's expensive to lay the copper. It gets stolen. It needs to be maintained. And then
people actually can't afford to keep those lines going.
And that's a great point, because when you're on a mobile device, you can pick and choose. I'm not going to phone because I don't have the money and you're not that important to me. Whereas with the fixed line, there's a monthly cost you've got to incur. And same with data and all of it. So I'm not sure there's enough space. The other problem that Cell C has is that, MTN and Vodacom are spending, 25 billion a year on infrastructure. And Cell C just never had that balance sheet that could manage that. Now, Telkom can, because they can leverage their existing backhaul network, and they've got a balance sheet that's strengthened by other bits of the business. They're not a standalone. So, Telkom might be the 4th player to come to market, but they're in a better position for it. So Cell C was never properly capitalized. So what do? You don't have enough cell phone masts out there, so you're doing a lot of roaming, initially on MTN, and I think they've now moved from MTN to Vodacom, or was it the other way? No, it's that way. Yeah. Which
and
means,
now they're considering.
Yeah, which means you get less bang for every rand, because you've got to pay the base station owner, and then you go into price wars to try and get customers, which means you're charging less, and you're getting squeezed on both ends. And so I never liked the Cell C business proposition. I never liked Blue Label buying a 45% stake, 5.5 billion ZAR that they paid for it. I think ultimately these telcos are utilities and they need to be priced accordingly, which frankly means a PE of 6 or 8 and a dividend of 6 or 8, and they're going to go kicking and screaming into that, but I think that's where they will end up. And Cell C tried Black, which is a streaming service, which cost them $1 billion, and I never met anyone who's used it. Because, Netflix and Showmax and YouTube and etc.
Everything but Black.
So I think it was a terrible idea by Blue Label and the Levy brothers to buy into it. They had a great business. They put $5.5 billion into it. They wrote it down to zero. When you put the $5.5 billion, you're expecting cash flow out of Cell C to help pay the debt.
Yeah.
No cash flow coming out. Now you are squeezed because the fact that
the debt's not going away.
The fact that Cell C is worth zero, the debt is not going away. So what did Blue Label have to do? They went and sold some businesses, 3G and others, for about R1 billion. but they sold businesses that are making about $300 million a year profit after tax.
So they're making them more money.
They're doing a fire sale here. Now, interestingly, they sold them to DNI. DNI is a subsidiary of Sabvest. So DNI has just bought one of some really great cash-generative assets on a PE of about 3 or 4. But Cell C is a distressed seller. They need to do it. And this is going to have longer term implications. Now, Cell C needs to be capitalized. There needs to be money. Blue Label can't do it. Net One can't do it. They lost their Concord battle.
Yes.
And that then leaves, so there's rumors that Jonathan Baer, with his Buffett Group, no relation to Warren, is looking to put some money in. But he's a dealer of note, and he's going to want the really good deal. And it means that their 45% stake is going to get diluted down to, I don't know, 30, 20, 10, 5, whatever the case may be. But it will, if Cell C gets recapitalized again for, I think, the 4th time, if memory serves, it does mean that their issues go away. But they've still got their debt obligation. That 5.5 billion rand that they borrowed, they still have a debt obligation. Yeah. So Cell C is in a very precarious position. I remember, Blue Label, when they listed in 2008.
And Cell C.
Blue Label had a great business model. I liked the way that the Levy brothers did deals. For example, they had a 12% stake they sold to Microsoft. It didn't work any synergies, so they raised money, bought it back, cancelled the shares. They've just been slick operators. And then they did a terrible deal. And the problem with terrible deals is the size of the deal, because everyone's going to do a terrible deal at some point. But if it's too big, then, just quickly touch on Woolworths and David Jones. That's a terrible deal, and it's a big deal, but it's not going to bankrupt the company. Cell C's probably not going to bankrupt Blue Label, but it's going to change the business for the worse, because they're selling crown jewels.
Oh, wow. Okay, so let's turn our attention to the international market. And before the we started recording, we were talking about Thomas Cook and, just what happened, and perhaps before we even delve into Thomas Cook, what does this mean for, and unrelated, but I think to a certain extent, there's just a shift from these sort of very big traditional firms who do things in the traditional way. And while Thomas Cook, it's not, solely because of tech, they made some investment decisions, which we're going to talk about. There is a very, there's a big shift to DIY style work. Be it planning your own holidays, Airbnb, all of these things that are just changing. So on the one hand, you've got traditional hotel groups, travel agency groups, etc., coming under pressure. And this is something else we'll touch on. You've got all these tech-based companies with these ridiculous IPOs, and we're going to talk about that. And the valuations, you look at the number and you go, when did we get to this number? How? But let's talk about Thomas Cook. What happened?
So Thomas Cook the business model is brilliant. So they own 154 airplanes. I mean, they are a giant airline. And what they do is they fill up an airline with Brits, and they fly out of an airport in the UK, and they fly to a destination, wherever it might be, Accra, wherever it might be. The Gambia is one of their big markets.
Mm-hmm.
And I love the Gambia. Don't forget the
Gambia.
No, the Gambia. And what they do is they drop you all off into the Gambia, where they own a couple of hotels, so they fill up the hotels, and they pick up another bunch of tourists who've been there for a week, fly you home, and then that airplane then goes to somewhere else and somewhere else and somewhere else, and it's a brilliant model.
It's a self-sustaining model.
Yeah, it's brilliant. Problem. So back in the 80s, I remember going on my first holiday with my mother, and it was, I don't know how she did it. She found us this cheap little place in Leisner without the internet. How did she do it? I remember taking my first flight when I was about 16 years old. And, it was quite simple. You went to SAA in West Street, Durban, in the big building, and you stood in a queue and you said, I want to go to Cape Town on this day. And they sold you a ticket. There was a competing airline, Comair. I don't know how you found them. But you didn't then leave SAA and walk down the street to Comair and then check out them. What we've now got is, to your point, travel's become DIY'd. Yeah, I'm doing a whole bunch of flying in October, and I go to my preferred airline, SAA, and their ticket prices are eye-watering, and their flight times are terrible. They want to get me from Durban to Cape Town via Joburg, and I'm like, that seems broken. So then I just go to Google, type it in, and Google comes up and says, well, actually, there's a BA flight at 912 Rand leaving at 11 o'clock, and that's perfect. So I can now shop myself. And so in the one sense, they got disintermediated by the internet in the classic sense. That said, it's still not everyone wants to manage their own holidays and the like. And I still know people today, and some of them are millennials.
Yes, I was about to say, I've got millennial friends. I've actually got a friend who recently went to Europe and was telling me about how the travel agent is doing this, and I looked at her with
and people still do package
confusion.
holidays. Now, to me, that sounds like a terrible thing, but that's a personal thing. There are people out there who Contiki tours and all of those sort of things, and this is what they do, and they do it via package holidays, and there's still a market there. So where Thomas Cook made the mistake was, I mean, the internet was coming. About 2008, 2010, they bought a competitor who had a significant presence in the high streets of the UK. And that's where they made the mistake. Because the high streets are expensive locations. You've got to have staff, you've got to pay rentals, you've got to have security and all of that sort of thing. And they essentially doubled down on face-to-face sales of package holidays when the world had moved to online sales. And if instead of buying a high street outlet business 10 years ago, they'd bought an online Kayak or any one of TripAdvisor, any one of those. If they'd bought that, they wouldn't be bankrupt right now, because their sales were simply costing, because that market still exists. As curious as me and you might think it, that market exists, but that market, all my friends who are doing it online.
Online, so they're not actually going to an office.
Although, oddly enough, I was in Pietermaritzburg earlier in the year, and there was a travel agency with a queue outside, which was just, it bent my brain.
It's Pietermaritzburg.
I know, it's Pietermaritzburg. I know. But, so that was just a mistake they made, and they've had a number of CEOs, and what they really needed to do was a wholesale closure of the high streets and a significant move into online. But that move should have been done 10 years ago, and they should have put the money into buying out one of these brands, which are now doing huge businesses for them, and killed a business that was 150 plus years old, and truthfully at a time when humanity is probably holidaying more than we ever have. We're it's cheaper, it's easier, we're wealthier as a species than we've ever been. There's more holidaying happening, but they just had the wrong sales channel. And it comes to the point you want to touch on in a moment, which is how companies get disintermediated, disrupted, pick the dis you want, and it's often just not from where you think it is. It's often just small little things, like how streets are dying.
Yeah. And on that note, moving on to WeWork, and valuated at about 47 bill just before their IPO, which was like 8 weeks ago, and then in about 5-6 weeks reduced to 10, and then some people were still like, yeah, that's a bit too high. Pulled the IPO, fired the CEO, who, by the way, decided when he was retrenching people, he would have Rand DMC come in after he gave them the speech that they've basically lost their jobs, so they could sing the song It's Tricky while holding tequila that he bought for them. And it's just been wild seeing, how do we get... And one of the first people that I sort of followed on the WeWork thing was a guy named Scott Galloway on Twitter. And he's just never bought... He calls them WTF. And he's just never bought into the WeWork story. And he's been very vocal about it. So seeing what all that he said sort of like come into fruition and going... I'm wondering what are we basing these valuations on? I mean, Airbnb is about to list, and their IPO is coming up, and I mean, I use Airbnb, so I'm to a certain degree, because it works for me, I can only assume that it's going to be a fair valuation because we're all using it. But
I hope so. And there's trickiness to it. So first, how do we get to that 47 billion valuation? So what happens is at different stages they raise money. So and then that valuation comes from the last round of money you raised, where you issued shares. So there's people who at 47 billion. That valuation puts them at break even. But there are also people who got in when the valuation was 4 billion and they've therefore made nice money. SoftBank being one of them,
yes.
being in the biggest and the initial.
Although now they're not so.
And we've also seen, so WeWork's a slightly different beast. Airbnb, Uber and the like. I mean, I wonder where all the money goes sometimes because, I mean, it's just a fancy website and just but obviously I'm missing tricks here, and there's a lot of legal stuff and I mean their insurance. For example, if you go to an Airbnb and something happens, there's insurance from Airbnb. There's a cost to that. There certainly are. But what we've seen as well, and I think this might be part of the outplay, is that the listings have been much later in the cycle. In other words, the 99 boom, companies were listing with a PowerPoint. We've got an idea and they had money. But now there's been so much more money available in the market for venture and startup and seed and angel and all of that sort of thing that you're listing much, much, much later, which makes for significantly larger valuations, which means you need a lot more investor buy-in from the process. If you were listing a little Amazon at a 100 million valuation in the early 90s, you needed a couple of bankers and all was fine. At 47 billion, you needed to really all go well. What we've also seen is the cult of the CEO get a little bit extreme. Who was the chap at Uber who got fired just ahead of Travis Kalanick and that man. And ditto with this man at WeWork. And there's a different type of person, not always, but the person who's required the person required to start a business and really disrupt on a global scale versus the person required to run the business needs different skill sets. And sometimes they can be the same person. Jeff Bezos, Bill Gates. Sometimes they can't be the same person, and you need somebody else. And WeWork's done crazy stuff. I mean, buying Lear jets, free beer and stuff. And essentially their business model is buy long, sell short. What I mean by that is they go in, they get an office block, and they sign a 10-year lease for office space. And because they're signing 10 years and they're buying a lot of space, they get a cheap rate.
Yes.
And then they rent it on the short term. And because they're giving it to you only a slice of it, and they're giving it to you on a day by day, week by week, month by month, short term lease, they can charge more. So there's an arbitrage. You're paying $100 and you're charging $200, and that $100 in the middle is profit. That's a nice theory. The practice is that this is not innovative. This has been happening for decades. They're giving you free beer and 6 months free space. And then you just flip from one to the next to get your free space. Me and you set up a business. First 6 months it's in my name, 6 is in your name. We get a year for free. And the valuations, they essentially are arbitraging long-short rental space. And that's nice. It's a property stock. It's PE of 10. It's not a 47 billion valuation. It's maybe a 10 billion valuation. So even if you remove the crazy CEO who had his voting shares had 50 times the power, he had clauses that he couldn't be fired.
Yes. I think even with the CEOs and the leadership, there were just so many scandals.
And I think what we're doing now, and if this had listed 4 or 5 years ago, they would have got away with it. But I think we've seen a lot of IPOs, Uber's underwater, Lyft's underwater from their prices. And in fact, I was listening to a Motley Fool podcast on the weekend, and I can't remember, but they had a list of, there's 15 or 20 fairly big IPOs from 2019 that are currently underwater, and it's just you're the wrong point of the cycle. You want to ride that wave, but you want to exit before it starts to sort of fold over and break. You got to get that timing right, and I think a lot haven't. And I think one of them is perhaps Airbnb, although I think Airbnb has a simpler, saner business model. Their leadership team seem to be a little less crazy. The valuations seem to be a little less stretched. So Airbnb might still come to market and manage to do it. But as you say, WeWork have just walked away and said, no, The problem with WeWork is they've got a giant debt obligation, and they needed $6 billion in dollars that was dependent on them listing, and that now falls away. The bigger trick is that when you're doing short-term rentals, the theory is they are one recession away from bankrupt.
Right, yeah.
So we have a recession, small businesses struggle, they cut back on required amount of office space, they cut back on all their office space, they go bust, and they're sitting holding long-term leases, and they haven't got any of their shorter-term renters.
Yeah.
And then the whole
Bringing
business
money
model
through.
just comes down.
Okay, well, Simon, thank you very much.
Always a pleasure.
For yet another insightful podcast episode. Let's see what October brings to us, and whether Trump will continue doing and say crazy things on the internet.
Probably.